Hello and welcome, everyone. This is your latest weekly market recap. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com. It's certainly a pleasure to be with you, all of you again this weekend. We had a big week last week. We saw the presidential election on Tuesday. Donald Trump won. Wednesday morning, the market spoke, and that's really what we care about, what's going on in the market. And everything turned up. We had a huge gap up on Wednesday. We saw buying really throughout the rest of the week. It was one of the best weeks we've seen in a long time. So let's go ahead and just jump right in and take a look at what happened, because there's a number of charts and RRGs and so forth I want to show you, because we do want to take a look not only at the price action, but also at the rotation. Okay, so let's take a look at the action from last week. We had small caps leading, mid caps leading, transports leading. But when you look over here to the right side, everything went up a lot. It was just what went up more. That was really the key last week. We got a Fed meeting. The Fed lowered interest rates again by another quarter. So we've got the short-term rates going down. Right now, the longer-term rates have been moving higher. So we are in the process of potentially uninverting the yield curve. And I can tell you one area of the market, or a couple areas of the market, that have really struggled with this inverted yield curve have been the small caps and the mid caps. So this whole scenario is not really shocking me. When Trump was elected back in 2016, we saw many of these same areas do the exact same thing. So anyway, and I'll talk a little bit more about what happened in 2016 a little bit later in the show. But yeah, I mean, you can see where the strength was across the board, but there was rotation toward the small caps. Moving on to the sector summary for last week, consumer discretionary. I want you to look at the top 6 groups here. Consumer discretionary, energy, industrials, technology, financials, communication services. That's all of the aggressive groups in the top 6, along with energy. As we saw crude oil prices move up, we had energy prices jumping as well. But those were the leaders. And then there was a little bit of a drop off, and you get down to the more defensive groups: real estate, healthcare, utilities, consumer staples, along with materials. So it was pretty clear to me: small cap, mid cap, growth versus value. Transportation stocks did really well. And, and you can kind of see that on the table. I will show you, though, an RRG in just a minute. I want to go through first and take a look at the Dow Jones. I want to go through all of these major indices and a couple of sectors and so forth, and take a look at the rate of change over the last 89 days. Now, the reason I'm picking 89 days, that takes us back to about the July 8th timeframe, which was right before the June PPI came out on July 11th. So from that point forward, we have seen a totally different stock market. We've seen a market that's been looking more towards small caps, mid caps, transports, some of these things that jumped this past week. This isn't a new rotation. This started months ago. And so what this rate of change will show you is that as I go through all these various indices, we can take a look and see what has done well since that July 8th period until now. So the Dow Jones Industrial Average up 11.72. If we take a look at the S&P 500, 7.69, so a little less. NASDAQ 100, NDX, 3.56, way down. How about small caps, IWM, 18.95%, almost 19% versus 3% on the NASDAQ 100. So if you've been watching some of your Mag 7 stocks and wondering, hey, whoa, market's going up, why aren't the Mag 7? Rotation. If you've got recency bias, you only look to what's happened over the last year or 2 years, which is Mag 7 stocks leading. That's not what's going on right now. So if you're buried, and the Mag 7 haven't been bad, everything's going up. We've seen a couple of the Mag 7 stocks break out, and I'll show you a couple of them in a bit. But the real strength in this market has been the IWM. So let's take a look, go just a little bit further here. Let's take a look at the mid caps, MDY, 14.19%. So they're up pretty good. How about that transport group I just talked about? How about 13.5%? Let's look at some of the sectors. XLF, 18.85. XLI, industrials, 17.6. How about technology? XLK, 2.02. So you can easily see XLY's done a little bit better, discretionary, 13.9. But leadership has come from those dividend payers, the XLF, the financials, the industrials, small caps, mid caps, and transports. Those are really some of the key areas that we need to focus on right now. And those areas, by the way, tend to outperform in the fourth quarter. So it's also a seasonal tailwind in these areas. All right, I promised you the relative rotation graph. Take a look at this. The benchmark is the S&P 500. And then on this chart, I have for you the Dow, the NASDAQ 100, small caps, mid caps, transports, all of the 5 aggressive sectors and the 4 defensive sectors. Now, as you zero in here a little bit, look at what is in the leading quadrant. This goes back, this is a daily chart, daily RRG. So it's going back over the last 5 days. That's what these lines are tracking. So when they're going up and to the right, that's good. You want to move in northeasterly fashion, which is up into the leading quadrant. XLY, transports, IWM, small caps, communication services. Here's mid caps, and here's the NASDAQ 100 over here a little bit further down and also further to the left than these others. But that's your leadership going in. Now, financials had rolled down and are starting to come back up. You can see it pointing back up into the leading. Technology, meanwhile, is in the weakening, but is actually starting to point into the lagging area. Then look at these red lines, the red arrows, XLV, XLP, XLRE, XLU. If you can't see it from the chart I showed you showing the table and the percentages, look at what the RRG chart's telling us. It's telling us the exact same thing, just maybe a little bit more visually appealing, but the same thing. Let's keep moving. S&P 500. So S&P 500 is broken out. The NASDAQ 100 has broken out. Russell 2000 has broken out. We'll see all those in just a second. But here is the S&P going up. And down at the bottom, I've got some of the key ratios I like to follow. Technology, actually, these are the sectors. These are not the key sustainability ratios, but these are the sectors I like to follow relative to the S&P 500. There you got technology. It's been going up for the past couple of months, but mostly it's gone sideways for the past 4 months. I mean, going back into July, we're still below where we were in, say, the 3rd week of July in terms of relative strength on the technology sector. Here's discretionary, though. Discretionary looks pretty darn good. How about communication services? Pretty darn good, moving up. How about industrials? Nice move, extended move, and same with financials. Financials breaking out to a 52-week high on a relative basis. So these are the 5 aggressive groups. Folks, when the market's getting ready to turn lower, Wall Street doesn't pour into offensive or aggressive groups. You start to see the market moving up with rotation into defensive groups. That's what we saw at the end of 2021 and early 2022 when the market entered into a cyclical bear market. This is not how you enter into a cyclical bear market, not with your aggressive groups leading to the upside. All right, now I'm going to show you the sustainability ratios. Here's that S&P 500. Big move to the upside again. Down below, QQQ relative to the spider, kind of looking like technology relative to the spider. It's been going up the last couple months, but it's really been buried in this sideways consolidation for the last several months. How about, this is my favorite ratio because this one lines up with the S&P 500. It more positively correlates to the S&P 500 than any other sustainability ratio I use. And look at the XLY XLP. I mean, it is soaring right now. This is a great sign for the market. So, I'm already hearing folks saying, oh, the market's gone up too much. It's, this is it. We're in the most bullish period of the year. I mean, I've talked about that time and time again, and we're seeing money rotate in very bullish fashion. You want to bet against this market, go right ahead, but just understand the risks of betting against the market. I know a lot of times we just think about the risks of owning stocks. You need to think about the risk of not being in. Moving on, IWF, IWD. This is large cap growth versus large cap value. This is what led throughout a lot of the last few years. it's doing okay, but it's not where the main strength is right now. Let's scroll down here to where the main strength is. This is the biggest moves, especially here in November. This is mid cap growth versus mid cap value. And this is small cap growth versus small cap value. Look at these versus these others. I mean, here's the discretionary versus staples, which is rolling. The others are going up, which is good, but they're not going up as fast. If you want to perform better in the market, you want to trade better, trade smarter, you've got to follow these ratios. You have to know where the momentum is. And right now, that momentum is clearly in the areas that I've been speaking about. All right, let's take a look at Apple. So Apple, and I just want to go through some of these Mag 7 stocks so you can kind of see. A lot of areas of the market breaking out. Apple isn't a stock that's breaking out. It's done okay here in November. It gapped down to start the month, and it's been coming back. That was earnings related, and then it's come back. That's okay. I mean, we're not bad. We're still showing relative strength versus computer hardware, which is good. Let's take a look at Microsoft. Microsoft gapped down with earnings. It's coming back, but look at its relative strength versus software. I don't know if you've noticed, software was absolutely flying last week. This is a group that's been underperforming for a while. We had a big move in software, and yet the biggest of the big, Microsoft, is lagging the rest of the area. So it's more mid cap and small cap growth. Take a look, or some of the other large caps. I mean, Palantir in the software group absolutely exploded last week. I can show you that stock. So here's Palantir making the big move up. Look at the volume coming in and look at the relative strength. Here is a stock leading software to the upside versus Microsoft, which is at a 52-week low. Doesn't mean Microsoft's going to go lower. It doesn't mean Microsoft's a bad company. It just means that it's out of favor right now. Money is rotating into other areas of software. When it goes back into Microsoft, we'll be ready to pounce on it then. But go with what's working. Palantir's in our model portfolio. Our portfolios are absolutely crushing the market right now. And I've told members, been telling members for quite a while, they were lagging. The model and aggressive portfolios were lagging. But I said part of it, especially with the aggressive portfolio, was that the aggressive portfolio is aggressive. It goes into small caps. It goes into mid caps. I think there's 11 stocks in our aggressive portfolio. 8 of them are either mid caps or small caps. So they don't do well when mid caps and small caps are underperforming. But now that we're in a period where mid caps and small caps are outperforming, our portfolios are absolutely flying. So when you think about our portfolios, members or non-members who want to come in and check us out, you need to be thinking about that portion. If you decide, and it's completely up to you, we're not registered investment advisors. I always say that. It's completely up to you. We use this for educational purposes. If you decide you want to get in, that's fine. But what I would be thinking about is thinking about our portfolios as though they're very aggressive funds. And so would you put your entire portfolio into an aggressive, really aggressive fund? Most would probably say no. So consider our portfolios as something that, a portion of your portfolio that's designed to be more aggressive, because we can see a lot of volatility in these portfolios. And when our themes are out of favor, I mean, if you look at our portfolios versus, say, something like Kathy Wood, I mean, she's got the ARC funds, and they absolutely got crushed from 2021 on. We kind of held our own with our aggressive. I mean, I think we did a pretty good job considering that the really aggressive small cap stocks have been out of favor for 3 years. I thought our portfolios held up pretty well. But now that we got the small caps going, and I think they're going to continue to go, our portfolios are absolutely on fire. And I'll show you those in just a second. Anyway, that's Palantir. How about NVIDIA? NVIDIA made a breakout again above that 140 level, went down, tested the 20-day, and now is broken out again. AD line looks great. Look at the relative strength on NVIDIA relative to the semis. There's nothing really deteriorating here. And what you need to know about NVIDIA is here's the seasonality chart. This goes back, I'm going to go back on NVIDIA 16 years, back to 2009 at the bottom. And I want you to look at the second month of each calendar quarter. February in quarter 1, May in quarter 2, August in quarter 3, November in quarter 4. Notice that they tend to be really strong months. This is when NVIDIA reports. They report on November 20th. So when you're looking at these, this seasonality chart, you need to understand this is the month when NVIDIA usually makes a pretty big move. Anyway, Meta. Take a look at Meta. Meta's just been kind of going sideways. How about Amazon? Amazon made a breakout, went above 200 for the first time ever. It's in breakout territory. This is a stock that I think is worth owning, or at least considering, because it has made the breakout. How about Costco? Costco makes the big move last week on increasing volume. Look at that AD line, or AD line up here. This is relative strength down on the bottom. So Costco looks good. How about Tesla? Tesla, I think, is probably more directly a Trump trade, just because of the whole Elon Musk and the conservatives and so forth. And I'm not getting into politics. All I'm doing is telling you what's going on with the stock market. You can make your own political, innuendos or whatever you want to do. That's fine, but that's not really what we do on this show. But Tesla, I think a lot of it does have to do with Trump winning. Big move last week. You can see it right on the day after the election, continue to push higher. We got a long ways to go for the all-time high, but I can tell you this is a big move. Getting through 265 back at the end of October. I talked about that. We went back down to the top of gap support, the 20-day moving average, bounced off of it. Then the election, got the big election boost, and Tesla right now looks absolutely solid. Look at the volume coming in on Tesla too. This is not light volume. How about something like Netflix? Netflix making a breakout in all-time high territory. Looks good. Google improving. Still looking at this relative strength, though, on Google. This is relative to its internet peers. Started to come off the bottom a little bit. I need to see a little bit more there. I think there are other internet stocks that I like better. We haven't broken out yet. Right up against this resistance at about 181. Let's get through that and then negotiate 191. And then maybe we'll be talking. But the AD line doesn't look as good as many of these others. And certainly that relative strength is well off its earlier highs. So those are some of the Mag 7 stocks and a few others that I wanted to go over with you quickly. I also wanted to show you a couple of charts that we provided to our Earnings Beats Digest community last week. So what we're looking at, and we try to teach trading strategies in this free newsletter. So, and if you get the newsletter, or if you don't get the newsletter, it's not a lengthy newsletter. We're talking about 2 paragraphs in a chart. So on SCI, what I was talking about, or what I was looking for, was small to mid-sized stocks that are breaking out. And you can see this one actually gapped up above the highs previously. So it opened above. I love to see these stocks get good news and open above key resistance. Then when it pulls back, it provides opportunities. We bounce off of that, and you can see the last week or so, very strong move on SCI. The other one that I put out just on Wednesday of this week, this was ISRG. And ISRG with earnings had made a big breakout. It had pulled back, and it was right in here that I featured it, saying that, when you pull back, you go back to a 20-day moving average. This is what I look for. I mean, if I had the poster child for how I swing trade, it would look a lot like this ISRG chart, because we're making that breakout. We're turning back to the upside. And, I think things are starting to improve there. Anyhow, I'm going to go ahead and wrap this thing up, but I do want to just say that, we've got a big event coming up next Saturday. It's going to take a look at the small caps. We're going to be looking at a lot of, the event is right here. We'll have a landing page up soon on our website. So if you want to go over to earningsbeats.com and sign up first for our free newsletter, go to the home page. Let me show you that real quick. You can scroll down. Here is where you can get the free newsletter. Try and get rid of that. I don't know why that even shows up there. Anyway, you can get your free newsletter just by simply putting in your name and email address, hitting that subscribe button. There's no credit card required. Comes out on Mondays and Wednesdays, just like those 2 charts I just showed you. SCI was on Monday. Intuitive Surgical was on Wednesday. Both were excellent trades. And like I said, ISRG is really the kind of stock that I like. I like a stock that's strong, breaks out, pulls back to a key support, and then I can get in for a swing trade, hold it for a while. Because in this kind of a market, I'm expecting it to go back up and break out again, which is exactly what ISRG did. But anyway, we will have a landing page up soon on here, and you can sign up for the event. It's going to be a completely free event. No credit card required. If you don't want to forget about it, go in and sign up for the EB Digest, because we will be reaching out to all of our EB Digest folks and sending out room instructions and so forth. So if you're on the EB Digest, or if you're already a paying member at Earnings Beats, you don't need to register. Okay, you're going to get invited. You'll be fine. But if you're just watching this, maybe for the first time, or you've been following me for a while, but you haven't subscribed to either our paid service or to the EB Digest, sign up for the EB Digest. You'll be entered. You'll have a spot in the room for next Saturday's event. I'm telling you, it's going to be an event you don't want to miss, because just look at the outperformance I was showing you on small and mid cap stocks. You want to capitalize on this strength. I have a pretty good sense of how long I think it's going to last and how far it's going to go. And I'm going to talk about it next Saturday. So put this on your calendar, 11 a.m., a little later than what we normally do. Probably will last no more than an hour. Try to have you out in time for noon. If you're a college football fan or whatever, try to get you out in time for any of the college football games. But this will be, I think, an eye-opening event that you don't want to miss. So be looking either for the landing page or make sure you sign up for the EB Digest. The other thing I said I wanted to show you this portfolio performance. We started the model portfolio in 2018 during the trade war. Remember the cyclical bear market in the fourth quarter of 2018? We started it right in the middle of that, right before we took a big drop in December of 2018. Since then, 6 years later, look at our return on our model portfolio, 250% since inception. Since that time, the S&P has gone up 122%. So we have more than doubled the S&P 500 over a 6-year period. And you can see that on the aggressive portfolio, we also have a huge lead right here, 136% versus 109% on the S&P 500. So big lead in both of those. But look at this quarter. This is what I really want to highlight. 19%, almost 20% on the model, over 24% on the aggressive. S&P 500 during the same period is up less than 7%. That's pretty strong outperformance when you're taking 10 equal weighted stocks, where in the case of the aggressive portfolio, we have 11 stocks. Here, I'll show you the portfolio. EXEL is a biotech and CSTL is a biotech. I put 5% in both of those. So we kind of spread our biotech risk among two stocks. But otherwise, all these other stocks carry 10% weighting, or they did as of the beginning of the period. Look at what they've done over the last 3 months. I mean, these aren't little 5, 10% winners. The worst performer is up 19%. Now, this goes back 3 months. Our current portfolio only goes back to August 19th. So this includes from August, what's the day? The 9th. So August 9th to the 19th. So it includes 10 days that we weren't in these stocks. That's why they're higher than what the overall aggressive portfolio is doing, because they were rolling back then too. But look at these 3-month returns. Folks, we're going to be unveiling a week from Monday the new stocks that go into all of our portfolios. And we're going to have a lot to choose from, given the way the stock market's been trading and the way we're seeing so much strength in the small and mid cap area. But I'll be picking my 10 favorites for the aggressive, another 10 for the model portfolio. And we have an income portfolio, which is obviously, it lags during bull markets. It's going to always lag during bull markets, because bull markets are mostly carried by aggressive stocks, more aggressive stocks that don't pay dividends or pay small dividends, as opposed to the value-oriented stocks that do pay much bigger dividends. So, the income portfolio, that's more designed for folks that really want to try to be a little bit more careful with their principal and they want to use the income perhaps to live off of. I mean, that's what a lot of folks, when they retire, they get into, they want that income portfolio so that they can constantly get the dividends to help, offset expenses and so forth. Anyhow, that's essentially what I wanted to go over today. Again, you can go over to Earnings Beats, go to our homepage, check us out, sign up for the 30-day trial, or at least sign up for the EB Digest. We'd love to have you. And again, we'll have more information on this upcoming event next Saturday on our website, early part of this week. So make sure, it might be over the weekend sometime. Anyhow, check that out, and hopefully I'll see you next Saturday for that event. But until next time, have a great week, everybody. Enjoy your weekend, and I'll see you later. Happy trading.